Welcome to this deep dive on maximizing retirement by navigating the tax trap of rollover decisions. Today we will unpack when it makes sense to convert pre-tax money, like a traditional 401k, into a Roth IRA, and when it does not. We will also cover safer alternatives, common pitfalls like the Backdoor Roth complication, and a simple decision framework. Let us begin by previewing the journey ahead. First, we outline why timing matters for Roth conversions. Next, we cover how conversions are taxed and how cash on hand affects risk. Then, we review safer rollover alternatives and the backdoor Roth pitfalls. After that, we will use visual decision tools and a practical timeline. Finally, we will work through quick math, summarize key points, and test your knowledge. With that roadmap in place, let us start with a brief disclaimer. Before going further, note this video is educational and not financial, tax, or legal advice. Tax rules change, and your personal circumstances matter. Please consult a qualified professional who understands your full situation before making rollover or conversion decisions. Now, with that important context in mind, let us move to the core idea of Roth conversions. The central idea is straightforward. A Roth conversion can be powerful because it trades taxes now for tax-free growth later. However, the conversion amount is added to your taxable income, and therefore timing is critical. It is generally most efficient during unusually low-income years. Additionally, if you cannot pay the tax bill from outside cash, the conversion can become financially risky. With that foundation, let us examine the mechanics of how conversions are taxed. A Roth conversion adds the converted amount to your taxable income for the year. The tax due is determined by your marginal tax bracket, which means additional income may also push you into higher brackets. Because of this, the strategy is most efficient when your income is unusually low, such as during a sabbatical, a career change, early retirement years before required minimum distributions, or a year with significant deductions. Next, let us turn to a practical step-by-step approach for deciding whether a conversion fits this year. To decide whether to convert this year, estimate your taxable income and project your marginal bracket with and without the conversion. Then, verify you have cash on hand to pay the tax bill without touching retirement assets. Avoid using Roth contributions to pay the tax if possible, because that depletes your principal and slows compound growth. Consider partial conversion size to stay within a favorable tax bracket, and plan a multi-year strategy if you expect several low-income windows. With this process in mind, let us visualize the decision using a flowchart. This flowchart begins with inheriting or holding an old employer plan. It asks whether a Roth conversion is being considered. If it is, the first gate is whether this is a low-income year. If yes, the next question is whether you have cash available to pay the tax bill. If both conditions are true, you can proceed with a partial or full conversion and reassess annually. If it is not a low-income year, the recommendation is to defer and plan for a future low-income window. If you lack cash to pay the taxes, you should avoid converting right now. From there, the chart directs you to consolidate pre-tax assets either into your current employer plan, if it has strong investment options and low fees, or into a traditional IRA. The traditional IRA path includes a warning that this may hinder backdoor Roth strategies due to the pro-rata rule. The outcomes emphasize simplifying accounts, optimizing taxes, and preserving flexibility. Next, let us focus specifically on paying the tax bill. Covering the tax bill with outside cash is the best practice because it preserves more assets inside the Roth to grow tax-free. While some consider withdrawing existing Roth contributions, not earnings, to pay the tax, doing so drains principal and slows future growth. Also, excessive withholding on the conversion can undermine the purpose of converting. If cash is tight, consider deferring or doing a smaller, partial conversion to fit your budget. With cash management clarified, let us review safer alternative rollover paths. If immediate taxation is too costly, a safer step is consolidation. First, compare investment choices, fees, and administrative quality. If your current employer plan is strong, consider rolling the old plan into it. If you prefer more control or broader fund access, a traditional IRA is another path, but it can complicate the backdoor Roth strategy due to the pro-rata rule. Regardless, consolidation can simplify your financial life and potentially reduce fees. Next, let us map out when low-income windows often occur using a timeline. This timeline highlights common low-income windows that make conversions efficient, including career changes or sabbaticals, early retirement years before Social Security benefits and required minimum distributions begin, gap years between retirement and the start of a pension, a year when income drops due to a market downturn, and years with unusually large deductions or credits. Side notes emphasize the tactic of filling up favorable brackets, avoiding bracket creep, and planning multi-year partial conversions. Building on that, let us discuss the backdoor Roth pitfall in more detail. A critical warning. If you hold pre-tax money in a traditional IRA, the pro-rata rule applies to any Roth conversion. This mixes your pre-tax and any after-tax IRA dollars, so you cannot just convert the after-tax portion tax-free. As a result, high earners who rely on the backdoor Roth commonly avoid holding pre-tax balances in traditional IRAs. If backdoor Roth contributions are important to you, favor employer plan roll-ins when possible to keep traditional IRA balances at zero. Now, to weigh choices at a glance, let us compare converting now versus waiting. Converting now accelerates tax-free growth and can reduce future required minimum distributions, but it creates an immediate tax bill and could push you into a higher bracket if the year is not actually low income. Waiting may allow conversion at a lower rate during a future low income window and gives time to accumulate cash for taxes, but the market might rise before you convert, and future income, or RMDs, could be higher. Next, let us look at how plan and IRA costs might differ with a simple illustrative table. These numbers are illustrative only. Strong employer plans often provide low-cost index funds with competitive all-in fees. Traditional IRAs can be very low-cost or higher depending on provider and fund selection. Weak employer plans may be more expensive, which is one reason investors sometimes roll assets out when eligible. With fees in mind, let us run through quick math to estimate a conversion's tax cost and bracket impact. A simple estimate of tax cost is the conversion amount multiplied by your marginal tax rate. For example, a $40,000 conversion at a 22% marginal rate yields about $8,800 of tax. To be precise, add the conversion to your taxable income, map it against the current bracket thresholds, and determine how much, if any, spills into a higher bracket. Then, size a partial conversion to fill your target bracket without entering the next one. Now, let us check your understanding with a quick quiz. Question: when is a Roth conversion generally most tax efficient? Options: A. During a high income year with bonuses. B. During an unusually low income year. C. Immediately after receiving an inheritance regardless of income. Or D. Only after age 59.5. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. During an unusually low income year. A lower marginal tax rate reduces the immediate tax burden and preserves more assets for future tax-free growth. Question: what commonly blocks high earners from using the backdoor Roth effectively? Options: A. Holding pre-tax money in a traditional IRA which triggers the pro-rata rule. B. Having a 401k at work. C. Owning a Roth IRA already. Or D. Using index funds. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is A. Pre-tax balances in a traditional IRA trigger the pro-rata rule on conversions, making the backdoor Roth less effective by creating unexpected taxes. Here are the key takeaways. First, convert in low-income years to reduce taxes. Second, use outside cash to pay the tax bill. Third, if taxation is too costly right now, consolidate to an employer plan or a traditional IRA. Fourth, be careful with traditional IRA balances if you plan to use the backdoor Roth. Finally, consider partial, multi-year conversions that fill your target bracket. To conclude, let us briefly recap and point you to your next steps. To wrap up, remember that Roth conversions trade taxes today for tax-free growth tomorrow. Success depends on timing and having cash on hand to pay the taxes. If the tax cost is too high this year, consider consolidating into an employer plan or a traditional IRA and wait for a better window. If you rely on the backdoor Roth, keep traditional IRA pre-tax balances at zero when possible. With these principles in mind, you are ready to make a more informed decision. Thanks for watching. If this video helped you, please like, share, and subscribe. I would love to hear your questions and strategies in the comments so we can learn together.